Key Person Disability Insurance. Key Person Disability Insurance is a policy that a company, like Able Incorporated, buys to protect itself from the financial impact of a key employee's disability. The company owns the policy, pays the premiums, and is the beneficiary. The premiums paid for this type of policy are not tax deductible for the company. As a result, the monthly benefits received by the company when the key person becomes disabled are tax-free. The purpose of this insurance is to reimburse the employer for the salary paid to the disabled key person, protecting the business from that cost. In a different scenario, if the company pays the premium but reports it as a taxable benefit on the employee's T4, the employee is considered to have paid for it. In this case, the employee is the beneficiary, not the company. The benefit received by the employee will then be tax-free. It's crucial for the company to correctly show the premium as a taxable benefit on the T4. Otherwise, the benefit would be considered taxable income for the employee. Business Loan Disability Insurance. Business loan disability insurance is a relatively new type of policy designed to make loan payments for a business owner who becomes disabled. The definition of disability for this policy is based on an own occupation definition, which is standard for business-related disability policies. To qualify for this insurance, the loan must be essential for the business's expansion or maintenance, not for personal use like a holiday. The loan must be from a legitimate financial institution such as a bank, trust company, credit union, or loan company, not from a friend or an illegitimate source. The policy typically provides periodic payments, often up to $10,000 per month, to cover the loan payments. Some policies may offer a lump sum payment, generally up to $250,000, or a combination of both. From a tax perspective, the premium for business loan disability insurance is not deductible and the benefit received is not taxable, effectively making it a wash. This type of policy is very popular among small or new businesses, such as a new dental or medical practice, to protect against the debt incurred to start the business. Business Overhead Expense, BOE Insurance. Business Overhead Expense, BOE, insurance is designed to cover a business's operational expenses if the owner becomes disabled. This is not insurance for the individual owner's personal income. It's for the business itself. The disability definition used is own occupation. What's covered? BOE insurance covers a range of business expenses, including rent and utilities, heat, hydro, property taxes and business income taxes, vehicle leases under the business name, salaries for employees, but not the owner's salary, interest on business loans, fees for professionals like lawyers and accountants. What's not covered? The policy does not cover the capital portion of a loan, only the interest. New capital expenditures, such as renovations or new equipment, incurred after the disability. The business owner's salary or the salary of a replacement employee. Salaries of independent employees or family members. Any future debts not incurred at the time of the policy purchase. BOE policies have a waiting period, e.g., 90 days, and a benefit period, which is typically 24 months but can be up to 36 months. BOE is a reimbursement contract, not an indemnity contract. This means the business owner must first pay the expenses and then submit invoices to the insurance company for reimbursement. If the monthly expenses are less than the policy's coverage amount, the unused benefit can be carried over to future months or added to the end of the benefit period, extending the coverage. From a tax standpoint, the premium paid for a BOE policy is a deductible business expense. However, because the premium is deductible, the benefit received from the policy is considered taxable income. Disability buyout insurance. Disability buyout insurance is a policy that partners or owners of a business buy on each other's lives. Its purpose is to provide a lump sum of money to buy out a disabled partner's or owner's share of the business. A crucial requirement for this type of insurance is a pre-existing buy-sell agreement. This legal agreement, drafted by a lawyer, outlines the terms of the buyout and must be in place before the insurance is purchased. The policy is generally only available to businesses that have been in operation for at least 2 years. The benefit is paid out as a tax-free lump sum similar to a life insurance payout, rather than a monthly income stream. The amount of disability buyout insurance cannot exceed the amount of life insurance held on the same individual. Instead of a standard elimination period, this policy has a trigger date, which is when the claim becomes active and the benefit is paid out. This trigger date can be 12, 24, or even 36 months after the disability. To determine the appropriate coverage amount, insurance companies will require financial documentation, such as the last 2 years of business financials and profit and loss statements. This insurance provides peace of mind by ensuring a mechanism is in place for a smooth business transition in the event of a disability.